Hi, everyone. This is Robert Keynes from goldsilverpros.com. Today, I'm going to talk about the relationship between real interest rates and gold and why gold may be your best opportunity to save long term. So we'll go ahead and get into the charts here. We have this interesting chart from the visualcapitalist.com depicting the 700-year fall of interest rates. Now, it's interesting to note that since 1310 to about the current time frame, 2018, there has been this trend line down, smooth sloping trend line down over those 700 years of lower interest rates. This is not a phenomenon that's occurred only in the US in the last 40 years or so. It's basically a 700-year trend. And the interesting thing to ponder is, why would we have lower interest rates over a 700-year trend? Could it be the rise of different types of technology, the Industrial Revolution, now the computer revolution, which has allowed us to get more output with less input? Is that we have more people on Earth and more overall labor? There could be a lot of reasons for that. The article goes on to hypothesize what could be three theories, and they're current theories. So these are just going to point to the last 40 to 50 years across the world and in the US. The first one is productivity growth. Since 1970, productivity growth has slowed as a nation's productive capacity is determined by a number of factors, including labor force participation and economic output. If total economic output shrinks, real interest rates will decline too, the theory suggests. Lower productivity growth leads to lower wage growth expectations. Again, that's just within the last 40 to 50 years. A second theory posited for the last 40, 50 years is demographics. They impact interest rates on a number of levels. The aging population paired with declining fertility levels results in higher savings rates, longer life expectancies, and lower labor force participation rates. So that could be a second reason. A third reason is economic growth. Dampened economic growth can have a negative impact on future earnings, pushing down the real interest rate in the process. Since 1961, GDP growth among OECD countries has dropped from 4.3% to 3%. And Larry Summers referred to the sloping trend since the 1970s as secular stagnation. During an IMF conference in 2013, secular stagnation occurs when the economy is faced with persistently lagging economic health. And one possible way to address the declining interest rate conundrum, Summers has suggested, is through expansionary government spending. They also noted that bond yields were declining during the same time period. That makes sense because interest rates and bonds are closely tied. You can see that since the 1300, global bond yields fell from around 14% to 2%. So very, very close to what we saw in overall interest rates, although interest rates started at 15 and went to closer to zero, just over zero. Bonds went 14 to 2, suggesting that the banks still want a little bit of rate of return on their money, but they do have to follow the overall trends in interest rates over time. That graph illustrates how real interest rates and bonds appears to slope across a similar trend line. And we'll get to what real interest rates here in a moment. While it may seem remarkable that interest rates keep falling, this phenomenon shows that a broader trend may be occurring across centuries, asset classes, and fiscal regimes. So these reasons that they gave in the article for the last 40, 15 years since 1970 really don't explain the overall 700-year fall, but we do know that fall is occurring. So if you're going to invest in fixed income, you can expect over time to receive less and less for your money. And when we get to the discussion of real interest rates, we'll see that that is often negative, meaning you actually get less out of it than you put into it for your perceived safety. So what are real interest rates? We have a nice chart here from long-term trends depicting the real interest rate. And real interest rate is basically this black line, nominal interest rate, minus the red line, the inflation rate, equals your real interest rate. So in other words, if the interest rate were 2% and the CPI were 2.1%, CPI being the consumer price indicator, the official measure of inflation in the United States, then your real interest rate would be negative 0.1%, meaning you would lose 0.1% of your money over time when considering the inflation rate in prices. And if you believe, as I do, that the inflation in some sectors of the economy, including energy, food, college expenses, healthcare, and others, is higher than the CPI, which it is, then you're really losing ground when you're investing in fixed income. So fixed income investments over time really don't help you preserve your wealth. If anything, they help you lose it, because we've had a 700-year decline in the rate in which interest rates are falling, and the bond yields as well. And when you consider the price of inflation, we're often in the negative territory. So basically, since the tech crisis of 2000, we've had almost the entire time a negative real interest rate. So if you had invested since 2000 over the last 20 years And most types of bonds, you lost money when considering inflation. There's a nice chart here, a nice paper here called The Golden Dilemma, published at Duke University, which talks about the relationship between real interest rates and gold. So let's say you're investing in bonds and it's not really giving you the returns that you want when considering real interest rates minus the rate of inflation. Well, would gold stand up well to declining interest rates? There's a chart in here on page 21 that I wanted to go over with you that I think explains the relationship extremely well. They basically charted the real price of gold against the real yield, 10-year Treasury inflation protected securities. And there is a correlation of about 0.87 to this chart, meaning that the real price of gold will rise as the real interest rate falls. So as you can see, the real interest rate is plotted here on the x-axis, and as it goes above 3-4%, the price of gold comes down on an index scale to a 2. And then it kind of clusters around there. As the real interest rate falls into negative territory or towards zero into negative territory, the price of real gold rises. And there's such a strong correlation, you basically can draw a line here, just like you can draw on this other chart when we're talking about real interest rates. The declining trend of real interest rates means you're going to get less for your fixed income securities, your bonds, your sovereign and corporate bonds. But if you invested in gold and as these interest rates had fallen, you would actually have made money on the gold trade. So this basically proves that over the 700-year history of declining interest rates, gold was basically one of your best investments that you can make. It was not fixed income. So then the question becomes, well, if fixed income is not the safe haven, what about the stock market? Well, I'm cherry picking some data here because I'm just going to graph it since 2000. But since 2000, you can see gold, as depicted by this line, has beaten all of the major stock market indexes, including the Dow Jones Industrial, the S&P 500, the NASDAQ, and the Wilshire. And it's really interesting to note that it's past the Wilshire, which is depicted by this yellow line here, because the Wilshire includes reinvested dividends. A lot of people advocate buying the biggest companies and taking that dividend because you get a return on your money. Plus you get the share price appreciation when you sell. Hopefully that's appreciated when you sell. But even the Wilshire takes 5,000 of those, puts them together, reinvests the dividends back into the stock, and it still is not anywhere near the increase in the gold price. Gold since 2000 has beaten the stock market indices by about 3.5 to 1. So not only are bonds long-term not a safe haven for your money where they're going to save your money against the real interest rate, against inflation essentially, but also the stock market since 2000 hasn't either. And over time, gold has actually returned more than the overall stock market because when you dollar cost average in your losses and your gains, the stock market doesn't return as much as simply holding gold. Well, why is that the case? I believe that's the case because gold holds its value over time against inflation. The best hedge against inflation is gold. And as the increase in monetary supply increases and interest rates continue to fall, gold has taken the opposite of that to the point of having a very high correlation. Gold price rises as interest rates fall. And now, currently, at this time period, I believe as of July of 2020, it was reported across the world that we also have $15 trillion of negative interest rate debt, meaning you actually have to pay someone to buy that debt. So let's say I wanted to go to Europe and buy a type of Euro bond. I would pay a face amount for a $1,000 bond, say at $1,500. Over the time of that bond, they may pay me $400 back in interest, and then I can sell the bond for $1,000, redeem it. So you get $1,400 back. That's a loss. You put in $1,500 and you got $1,400 back. Not only is that a nominal loss, but when you consider real interest rates or the rate of inflation, this red line here, you actually lost more than that because by the time you got the $1,400 back, maybe it was only worth $1,300. So instead of losing $100 on a $1,500 investment, you may have lost $200. However, if you had simply bought gold during that time frame, you would have seen a nice, healthy appreciation in the purchasing power of gold as an asset. I believe this is because gold is money. I also believe silver is a type of money, and that's why gold and silver are such great investments. And I believe over the long term, it's not the stock market or bonds that will help you save money. It will be in gold, and during times of declining real interest rates and during times of excessive debt, printing like we've had across the world, including negative interest rate debt, gold is simply not only a safe haven, it's your best producing asset in real terms. So this has been the first video in the fundamental series that we'll be posting every Sunday. Negative interest rates are a very powerful indicator of the gold value over time, especially when considering alternatives in bonds and stocks. Maybe not as rosy as the financial media would have you believe. Certainly looking at a 7-year history of falling interest rates on fixed income makes those investments much less attractive. It also points out that the debt-based fiat money system does not provide true wealth over time and is not even a safe haven in terms of preserving purchasing power over time. We have to look elsewhere for that. The stock market is often hyped, but over certain periods of time, most periods of time, doesn't really provide great returns when you consider the ups and downs of the stock market and dollar cost averaging in. Certainly, if you could perfectly pick every peak and every valley in the stock market, you may do better than the average, but 99% of people will never be able to do this. And I believe long-term gold and silver are your best assets for long-term wealth preservation. Gold, of course, probably being the more stable of the two, but silver having immense potential, especially here in the short term, the next 2 to 3 years, to provide a lot of return for investors because it's been such an undervalued asset. This has been the video for today, guys. Hope you appreciate it. We'll do more fundamentals going forward. This is Robert Keens from goldsilverpros.com.